Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael Siding. All right, let's conclude this deep dive of Apple with some CAGR calculations and risk assessments and put it into the context of the general macro environment. So, after going through these DCF calculations, reverse engineering, growth rates and discount rates and to see how overvalued or undervalued is it and what exactly is mathematically discounted in the market. Since we can't know the details in the DCF and in the market's thinking, we have to assume one or two of the variables and then see what falls out in terms of the last variable. And we saw in the last example how using my requirements resulted in an inbuilt expectation of 17% annual growth, which is highly unlikely given the current situation for Apple, with trade wars, lackluster growth for a long time, difficulty in finding new products to rekindle growth. But now let's move over to the more pure play P equals F times V method to see what we can conclude regarding total annual returns. So first we have last 12 months EPS level is 6.40. I consider that pretty much a representative number. Apple is such a huge behemoth, and their trajectory has been pretty smooth in terms of sales growth and profit margins. So 6.40 is a really good normalized starting point for the last 12 months. Now, remember that if you use a last 12 months estimate to start with, if you want to know the 4-year CAGR in the end, you should move ahead time by exactly 4 years as well, and imagining you are looking back at the just recently reported last 12 months number. So we're starting with 6.40, and then we project that 4 years out using an 8% growth rate. So 6.40 times 1.808 to the power of 4, and that comes to 8.70. And here's a pretty easy way you can calculate that. You simply use the DCF calculator. You enter 6.40 as a free cash flow, and you enter the growth rate that you want to see, what that results in terms of a future EPS rate. And then you just check, because here in TradeBrains you have all the annual calculations, and you see that after 1 year of 8% growth rate that you inputted in the formula, it's at 691, and then 746, 806, and after 4 years it's at 870. You also have a lot of other interesting information, the discount factor and also the value, the discounted free cash flow value. So this 8.70 discounted by 15% for 4 years, that's actually worth 4.97 as of today, if you would want to use that for anything. And since we have all the calculations here, you can choose whichever year you want as your end point for your CAGR calculation. But I will use the 4 years out, 8.70. And then using a 4-year backward-looking warranted price earnings level of 16.5. So that is what I think is actually approximately warranted for 8% EPS growth. That's what we should expect the average company actually on the market to grow by. And then calculating the future warranted share price as 16.5 times 8.7, we arrive at $143.55 per share in 4 years. 4 years from now, we will get to there from the current 199. And that, of course, come to a negative number. We don't even need to check what it is. We're losing more than 25% of our holding, and we have to wait 4 years to get there. That's a pretty lousy deal. Total return, well, we would need to add the dividend yield. If you want to, you can always check what the dividend yield is in investing. If you don't care to calculate it yourself or find the actual numbers, and you can see here that they state the dividend yield here as 0.5%. So they are distributing just $1 per share, so 0.5% addition. I've used the 1% estimate here. Well, there is no reason to believe that they will suddenly double their dividends, but in any way, this is even more negative. So they have a 25% loss in share price over 4 years, and then on top of that, just 0.5 percentage point in additional dividend yield. So this is a pretty negative total return type of stock using an estimate of 8% EPS growth and a market level multiple. If we were to use if you wanted to calculate what the actually expected future multiple is, we simply take today's share price and divide it by the future EPS, and we can see that it comes to a 22.3 times multiple. Today's share price over the 4-year future EPS. So if the stock price were to just stand still over 4 years, then we would still be at a 22 times EPS multiple, and having had to wait 4 years for that. So this is the type of risk we're talking about. So what if they, for example, miss the 8% EPS growth rate? Then the future EPS would be lower than 8.70. And what if the future valuation multiple then, I mean, if they have only grow by 3, 4, 5% over that long period, then they would probably be punished with an even definitely a lower multiple than 22, and probably even below the market multiple. So this is a way to try to assess what our downside return risk is for Apple. Remember again that I like to keep the risk assessment and the return assessment separate, because the risk assessment is so subjective and it's fraught with potential errors and vagueness. So keep them apart. But what you should remember is that the real risk, is your uncertainty and ignorance. It's the risk of a permanently lower cash flow generation versus expectations. So it's the risk of a permanent profitability miss. And then we can we have already concluded that this is not a stock to invest in. It's priced to perfection. There's a pretty huge downside, both technically and fundamentally. We have a very high valuation of the market. This is how it's looked the last 100 years, and it's getting up there. This is the CAPE valuation estimate, and this is Hussman's kind of price sales type estimate, which looks even worse than the CAPE. The CAPE estimate does not take into account that margins are typically cyclical as well, so margins will typically drop in a recession. And then on top of it all, we can see retail investors currently piling into the market in record amounts. So it's like the FOMO has taken hold of retail investors while institutions are actually selling at this point. So possibly the retail does not understand the risks we are facing. So in conclusion, everything is negative for Apple, I would say. TA for Apple, TA for Nasdaq, the valuation is too high, and we have macro headwinds. So it could easily fall by 50%.